Hello everyone. We saw the Reserve Bank of India Monetary Policy Committee deliver a rate cut of 25 basis points, with most of the members voting in favor of a 25 basis rate cut and just one member voting in favor of a 40 basis rate cut. So the repo rate in India stands at this point in time after this action at 5.15%. This was largely in line with market expectations and also ours. One critical thing in this monetary policy review statement is that they would intend to continue the accommodative bias so long as growth revives. And I think that's a very positive statement which suggests to us that the rate cut cycle or in terms of easing is not yet over. How did the bond markets react? Well, as I mentioned, there were expectations in the market of at least a 25 basis rate cut. So we had actually seen the yield curve ease a little bit. The 10-year benchmark bond yield was trading at about 6.61% around the policy, obviously sold off a little bit to about 6.64 to 6.65% post policy. One more reason for this bond going out of favor a little bit is we are going to see the issuance of the new 10-year benchmark bond, which means that the current 2029 bond will soon run out of favor. The incremental liquidity, as we see more issuances, will continue to favor the new 10-year benchmark or the new 2029 bond. That is likely to trade at least 15 to 20 basis points lower than the current old 10-year benchmark. The overall yield curve, I think, will likely remain anchored around the current levels because there is nothing untoward or very negative in the overall stance of the monetary policy statement. Growth forecast has been revised on the lower end. The growth slowdown is clearly palpable with every incremental data point that we have been tracking. While there was no mention per se on the liquidity factor, we've already seen steps to ease out liquidity. The new RBI liquidity framework also suggests that they will maintain adequate liquidity, which means a combination of various factors, including tools such as open market bond purchases, if needed, to inject liquidity into the banking system. There seems to be lingering concern, even at this point in time, on the lack of adequate credit offtake from the banking system to the real sector. With a rate cut, another rate cut, I would say, we are heading gradually in the direction of enhancing the transmission of credit to the real sector. The overall NBFC crisis, which started off with the ILFS, in fact, September 2019 actually marked the anniversary of the ILFS default, continues to plague the bond markets. We are seeing bond yields at elevated levels. In fact, the spreads between the high-grade bonds and the slightly lower-rated bonds continue to remain elevated. We believe that these are opportunities to start nibbling into well-managed balance sheets and construct a credit portfolio at the current levels. Going forward, while the trajectory of interest rates will continue to be lower, it may not be a one-way downward movement. It may not be a unilateral movement across every section of the yield curve. We believe that the 1 to 5 year segment of the yield curve would remain the sweet spot, both from a liquidity comfort perspective as also from an incremental rate easing perspective. We therefore urge investors to continue to position fixed income strategies which have incremental positions around this segment as part of your investment portfolio. Either which ways, with repo rates coming down on an incremental basis, we believe it is imperative for investors to enhance duration across fixed income strategies, which means if you are in liquid, graduate to ultra short term, from ultra short to low duration, and thereon keep laddering up your maturity and ride through this entire likelihood of benign interest rate scenario. Spoil factors, party poopers could be obviously the high crude oil prices, intermittent spikes, some geopolitical tensions lurking around, and obviously global bond deals if at all they inch up on a risk on kind of a movement. We assign tail end probability of these events panning out. So by and large, the view on interest rates continue to remain benign, and therefore we urge all investors to stay put, stay invested, enhance durations across your fixed income strategies. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.